All right, so let's get into financing here. I put together some kind of thinking points for you about financing and first and foremost, the importance of putting putting the horse in front of the cart. Your financing strategy is the gas in the tank. It is what really drives your acquisition process. Until you've talked with a knowledgeable lender, it's all hypothetical. I thought of this great analogy in my mind of, okay, you go to the grocery store, you fill up a whole cart of items. Let's say it's during a pandemic and you've hoarded a bunch of toilet paper in your cart even, and you get to the register and you realize you don't even have your wallet with you. One, that's embarrassing. Two, it was a waste of your time. It's going to be a waste of some store clerk's time. It doesn't matter that you have the money at home. You didn't have the wallet in your pocket, you know? So there is a certain importance of just having your financing plan in order, having a pre-approval letter in hand or proof of funds in hand so that that seller can see that you are a buyer, not just a tire kicker, not someone who's just trying to see what's out there. You've got to consider, Joe, you kind of mentioned this earlier, you've got to consider the supply and demand imbalance for loan products. Everybody right now is not only buying properties, but they're all refinancing the homes that they already have. So think about these poor lenders. They are slammed. They have more work than they likely want and probably more than they need. Not that that excuses poor customer service, though, it's understandable under these circumstances. It's just a product of the reality that we're in. We've already kind of harped on this. I mean, you're going to have to plan to call on your grit and determination to get you to the closing table. I've found underwriters to be ultra picky right now, and I think that's understandable as well. Especially, I think probably 6 months ago, I closed on a property and they did employment verification, I think like 4 or 5 times. Yeah, I mean, same day as our closing, in fact. I mean, we had to go and Joe, you know this, when you're in the military, that's not an easy thing to go back and get. So, I think you've got to be prepared to have to jump through a couple extra hoops, especially as it gets down to the wire. Appraisers have been spread super thin as well. So I've had a couple closings where it was challenging for them to find an appraiser that worked with the schedule of the builder. So again, just be prepared. All this is normal. I know that for people who this is their first time going through this transaction, and maybe your first time doing it without a buyer's agent, this can all feel like it's, these are red flags, that I shouldn't be doing this, all these hiccups, all these challenges. But the reality is these are symptoms of the market. And so we've got to be a little bit gritty and a little bit scrappy to get these deals to closing and to get the properties that we want. There is, of course, an upside to the financing. Interest rates are extremely low. Investment loans are somewhere between 3.5 to 4. That is incredible. Joe made a great point last time we did sit down with all 4 of us. He said, and he's coining this phrase, I think we need to add a little Joe Torre trademark here. The 0.8% rule is the new 1% rule. And I think that is in part from just the fantastic interest rate. So this is a repeat slide of what he showed us last time, but this is a pro forma of a typical property in Cleveland, Ohio with a purchase price of $100,000. We're using the 1% rule, which is the litmus test that a lot of investors like to use to determine if a property is a good one. So that 1% rule says that this home would rent for $1,000 a month. We've assumed for this pro forma a 6% interest rate to demonstrate what it used to, or how this property would have performed maybe a year ago. So it cash flowed $218 a month, which is a really solid return, especially when you consider that there's a maintenance overage in there as well. So now we are testing this theory of the 0.8% rule against the 1% rule using the same interest rate, using 6%. And you'll see that, hey, if interest rates were still high, then yeah, that 0.8% rule is definitely, it does not compare to the 1% rule. This home barely cash flows. But when we pull in a lower interest rate, a 4% interest rate, which I would argue is maybe a little bit conservative right now, you see that this home with an 0.8% rule offers pretty decent cash flow. Still not maybe as good as the 1% rule at 6% interest, but look at that savings there. So for those of you who are still insisting on only finding properties with the 1% rule, you're probably discouraged as you've seen prices kind of slowly creep up. But what you've got to keep in mind is that these interest rates help us to keep our costs low and keep the property cash flowing really well. Another financing upside, I have said this just kind of in private conversations of my own. I kind of wonder, we can all look back at the last housing crash and we can see where the opportunity was. I mean, buy houses for pennies on the dollar, right? It's hindsight is 2020. So I have found myself like wondering, okay, when we get 10 years removed from today, what are we all going to look back out and see? I mean, what was the opportunity there? And I've kind of wondered if it's the interest rates. Having interest rates in some cases half of what they were just a couple years ago makes a huge difference. It lowers our monthly holding costs and it offers us more efficient principal pay down month over month. So you've got to consider, and this is something I think in my own investing process have really started to try to be more mindful of, and that is the benefit of having larger loans because they are a little more efficient from a principal pay down perspective. And then I have the added boost of the interest rate being ultra low. So I think it's a great time to get a good size loan. Certainly adhere to the fundamentals. Don't go pay $300,000 over asking price for a property and call that a big loan with efficient principal pay down. Still keep your sense about you. But I wanted to show you guys a personal example here. So these are real numbers from a deal that I'm closing right now. This is my quadplex in Jacksonville, Florida. We are closing on that next week, hopefully. We've been stuck a little bit in the delay game too. We contracted this quadplex back in August of 2018. Now, I hear the eyes rolling. We knew that it was going to be a long closing time frame for this particular project, so I'm not too shocked by that date. But when we first considered this property, we had our lender run up a fee sheet for us to show us what our loan costs would be. And they gave us a 5.625% interest rate. So I put that in a little mortgage calculator so that you could see what my monthly payments would have been and how much interest I would have been paying over that loan. Well, we have locked our rate. We've got our final closing disclosures here in March of 2021, and we are closing on this property with a 3.5% interest rate. So I just want to point out to you the difference that interest rate made on this deal. All other things the same. This property is a way better deal than it was, and it was good at the time. So this added over $500 a month to the monthly cash flow of this particular deal. My principal pay down, I went and looked at the principal pay down schedule. In the first year, I'm accruing $200 more per month of principal pay down. And then as you can see there, over the term of the loan, over the 30 years, the interest savings that I'll have, or that my tenant will have, I suppose, is over $180,000. So this for me, and I think it was kind of this process that has sort of revealed to me the power of borrowing and the importance of considering principal pay down, and why now I feel a sense of urgency to find good fundamental deals that make sense today and put them under contract. Because here's the good news. To your point earlier, Aristotle, this quad that I put under contract 2 years ago is worth more now than what I paid for it as well. So I'm closing with instant equity. Rent prices are higher than they were when I contracted it too. So on all ends, this property is kicking pants. I mean, it's a great deal at the end of it, and the interest rates I think are a very large part of why.
Yeah, thanks for sharing that. That's an eye opener for a lot of people, and it just goes to show you that it's not about the purchase price, what was cheaper 3 years ago versus now. It's about the payment. Look at your payment. It's
right.
Significantly lower, even though the prices have gone up.
Here's the other thing I noticed to kind of look back, look at these amortization schedules, like look at the crossover point. So the yellow on the top is the interest that I'm paying on the loan. Of course, they're going to front load the interest because they know that you usually sell a house before a 30-year period, right? So yellow is interest, green is principal. The crossover point of when my payments start becoming more focused on principal instead of interest is earlier too. So it incentivizes or it enables me to have a shorter term hold and accumulate more of that principal pay down as well. All right, so I want to do a quick recap on financing, because again, I don't want to harp too much on this, but I think that the financing strategy is really important. These are just the general qualification criteria for a conventional loan. So you're most likely going to need a credit score of at least 680. You need to have a 2-year job history at a US company. This one can be a kicker if you were furloughed during COVID. Or had a change in your employment, that could impact your ability to get a conventional loan. So you definitely want to have a conversation about that. You got to have at least a 20% down payment. In some cases, you can put 15% down, but there will be some extra costs if you choose to put that down. Reserve funds, so the bank is going to want to see that you also have a specific amount of capital available for reserves. They want to see a low debt to income ratio, less than 50% in most cases. And then you don't want to, or you can't have more than 10 financed properties under your current credit report. So these are just general guidelines, but if you're seeing something here that you think could be a hiccup or possibly be a problem, it's best to get on the phone with a knowledgeable lender to talk through your specific circumstance so that you can find out what your borrowing potential is. Again, preferably before you start going shopping for houses. So we've got a list of conventional lenders on our website that we recommend. You can find them on the investor portal. This is a little screen grab here of the investor portal. When you're logged in, you'll see this black navigation bar across the left-hand side. Under the resources section, you'll see there's a lenders tab. Those 5 lenders that you see there all specialize and work almost exclusively with real estate investors. So they're going to have really competitive rates and terms. They're familiar with all these teams that we work with. They are the preferred lenders in most cases of the teams that we work with. So I always recommend to people, I mean, here's one of the benefits of RealWealth is that we've had webinars with many of these lenders before, and we've archived those historic webinars under their page here. So if you want to go and kind of get a feel for Ridge Lending Group or Highlands Residential Mortgage, click on those names there and then watch the latest webinar that we did with them to see if there's somebody who you could see yourself working with. But once you kind of identify a lender, get yourself pre-approved so that you can be in that buy seat. We also have some non-conventional lenders too. Just below lenders there, you'll see there's a non-conventional lenders tab. We've got 2 of them there. We've got 2 no recourse lenders. This is the required loan type if you are investing with a self-directed IRA. Property teams also have their own preferred lenders. As I mentioned, our list is pretty consistent with their list. There's a few exceptions in 1 or 2 markets, but by and large, they're all licensed in all the different markets. But you can always confirm that by going to the property team page under the How to Invest tab. You'll see there's a lender section where we've listed their preferred lenders, so you can verify there as well.
Hey, Leah, just for people who don't understand, what's a non-conventional lender?
Yeah, so, well, it's a much broader term. Non-conventional lending would be anything that's not a conforming loan. So this could be a private loan. This could be a commercial loan. I tell people when they want to know what are the typical terms of a non-conventional loan, it's like, well, there are probably endless combinations of terms for a non-conventional loan. Anything you want to add to that, Aristotle?
Yeah, no, just the biggest thing that we get is for people who say, well, I already have 10 loans in my name. Well, what do I do? Well, you can contact a non-conventional lender and they can do beyond what Fannie Mae and Freddie Mac can do, right? So people ask us a lot. And the interest rate is definitely going to be higher. I'm seeing right now like around 6% for a non-conventional loan. They are fixed though. Most of them are fixed for 20 or 30 years, which is good, but it's the only alternative you really have. And so if you get into like a high cash flow property, the numbers actually work out pretty well, but not so good on a new construction if you're looking for a non-conventional, in my opinion.
Yeah, one other consideration too, some of these new home builders, they have their own preferred lenders. And if you use their lender, they'll give you a couple $1,000s off on the closing costs. So that might be something to consider as well if it's a new construction property.
Yeah, I think that's a good point. It's worth kind of looking at the numbers. I had that with one of my builders. He had a preferred lender, and I don't love to venture out away from my preferred lender, but the builder was offering a great credit, so it was worth all the arduous paperwork to see if it was a better deal. And in the end, it was one that my lender couldn't compete with. So I'm going with it.